Drake just learned that banks report large cash transactions to the government, so he's decided to be smart about it. He's withdrawing $9,500, just under the $10,000 limit, to avoid the report. Technically, I'm not doing anything wrong. It's under the limit. I'm just being careful. Daniel is making a single cash transaction of $12,000. He fills out a simple form, the bank files a report. That's the end of it. No problem. The form takes 2 minutes. Clean money, nothing to hide, I'm not worried about it. Here's the part Drake doesn't know. What he just did is a federal crime. And what Daniel did is completely legal. By the end of this video, you'll understand the difference and what these rules actually mean for your everyday banking. Let's start with the rule itself. Under the Bank Secrecy Act, a U.S. federal law in place since 1970, banks are required to file what's called a currency transaction report, or CTR, anytime a customer makes a cash transaction of more than $10,000 in a single business day. This applies to deposits, withdrawals, or exchanges of currency. It applies at banks, credit unions, and many other financial institutions. And it is entirely automatic. The bank does this, not you. You don't fill out the form. You don't get penalized for triggering it. It's not a red flag by itself. The report goes to FinCEN, the Financial Crimes Enforcement Network, which is a bureau of the U.S. Treasury Department, not the IRS. The IRS can access this data, but the report itself doesn't go to the IRS directly. The bank just files the form. I make my deposit. That's it. The report being filed doesn't mean I've done anything wrong. Exactly, most large cash transactions are completely legitimate. Real estate sales, business transactions, inheritance, selling a car. The government isn't assuming you're a criminal. They're building a record in case something turns out to be criminal later. The key word is, your money is still yours. You can deposit or withdraw any amount you want. The bank will file a report above $10,000. That's not an issue, unless you try to avoid it. Now for the law that Drake accidentally broke. It's called structuring, and it's a federal crime. Structuring means deliberately breaking up cash transactions into smaller amounts specifically to avoid triggering the $10,000 reporting requirement. Drake's $9,500 withdrawal? Classic structuring. Here's what makes this so dangerous. Structuring is illegal even if every dollar of your money is completely legitimate. It doesn't matter that Drake earned the money honestly. The act of intentionally avoiding the report is itself the crime. Federal prosecutors don't need to prove your money was dirty. They only need to prove you were trying to avoid the report. But I was just being careful. My money is clean. I pay my taxes. That defense rarely works. The government's argument is simple. If your money is clean, why were you hiding it? Banks are also trained to look for patterns. Multiple transactions just under $10,000 at the same bank on consecutive days from the same account? That pattern triggers something called a suspicious activity report, which can be filed regardless of transaction size. There's no dollar amount you can structure to avoid a suspicious activity flag if your behavior looks suspicious. To be clear, not every split transaction is structuring. If you withdraw $8,000 today because that's what you need, and $5,000 next week because that's what you need, with no intent to avoid reporting, that's not structuring. Intent matters. The crime requires that you specifically intend to avoid the report. But I didn't know is not a defense that holds up well in federal court, which is why you're watching this video. Let's be clear about what actually triggers IRS attention, because the internet is full of bad information on this topic. Having a large amount of cash in your bank account is not illegal. Making large cash deposits or withdrawals is not illegal. Earning cash income legally and depositing it is not illegal. What draws scrutiny? Making multiple transactions clearly designed to stay just under $10,000. Sudden large cash deposits with no clear source. Cash-intensive business deposits that don't match reported income. Transactions that look inconsistent with your normal account history. The IRS doesn't watch every transaction in every account. What they have access to is CTR data above 10,000, suspicious activity flags submitted by banks, and information from audits and investigations. For the vast majority of people with clean, ordinary income, none of this matters in daily life. I document large cash transactions. I keep records of where cash came from, sale of a car, birthday money, whatever it is. Clean records solve 100 problems before they start. Now let's talk about the practical question most people actually have. How much should you keep in your checking account? The IRS reporting rules don't tell you how much to keep in checking. That's a financial planning question, not a legal one. Here's the framework that makes sense for most people. In your checking account, keep 1 to 2 months of essential expenses. This is your operational float, rent, utilities, subscriptions, food. It needs to be liquid and accessible. Nothing more. 3 to 6 months of total expenses should be your emergency fund, ideally in a high-yield savings account, not checking. Your emergency fund should work while it waits. Everything above that, money you don't need in the next 6 months, should be invested. I've got $20,000 in checking. It's just sitting there. I feel safe with it there. At a 0.01% annual yield, which is common for big bank checking accounts, Drake's $20,000 earns $2 per year. A high-yield savings account could earn over $800. And if that $20,000 was invested in index funds, the long-term opportunity cost is enormous. Keeping too much in checking isn't illegal, but it is expensive. Here's what you need to know. 1. Banks must file a currency transaction report for cash transactions over $10,000. This is automatic, routine, and not a problem if your money is legitimate. 2. Structuring, breaking up transactions to avoid the $10,000 report is a federal crime under the Bank Secrecy Act, even with clean money, even if you didn't know. 3. Suspicious activity reports can be filed for any pattern that looks unusual, regardless of size. Behavior matters, not just dollar amounts. 4. In your day-to-day banking, keep 1 to 2 months in checking, 3 to 6 months in a high-yield savings account as your emergency fund, and invest the rest. This video is for educational purposes only and is not personalized financial or legal advice. If this helped you, subscribe. We post a new personal finance video every week. Next, speaking of big financial decisions, buying a house is the biggest one most Americans will ever make. And there are 5 things you should check before you even make an offer. We'll cover those next.